Thanks for joining us yet again for Crypto Talks by Calcone. I'm your host, Sage. And while the investment community is drawn towards digital assets, the market cap now reaching over $2 trillion. Although some government regulators consider crypto to be a financial instrument or just a commodity rather than a currency or asset class, as it has no underlying value. There are many advocates for decentralised finance built upon the blockchain and the liquidity it could offer to many sectors of the economy. So to help gain some clarity, we have sourced some of the brightest investors in the field to share their insights from working in the space. And today we have two special guests from Portal Asset Management, the founder and CEO, Mr. Deryck Graham, and the Chief Investment Officer, Mr. Mark Witten. They'll share insights on running the Portal Digital Fund, which is an actively managed global fund of hedge funds focused on the digital currency investment space. And the fund seeks to achieve medium to long-term growth through investing in a diversified portfolio. So welcome to the show, Deryck and Mark.
Thank you very much, Sage.
Calcone Media is excited to have you with us, and we're keen to hear your insights now. So let's get started. It's practically an endless summer for Portal Asset Management, being headquartered in Singapore with an office in the Cayman Islands and Perth, WA. How is Portal positioned to harness investors from the APAC region? Does this include retail investors as well as institutional investors, please?
Look, I think maybe first we might set a bit of context to the space, if that's okay, Sage. This space is now $2 trillion in capitalization. We consider it the fastest, possibly the most disruptive financial technology in history coming. And so we look at investing in the space, realizing there's 10,000 new tokens in the space. Decentralized finance has come on board. There's nearly $80 billion of locked up value in decentralized finance, fully autonomous financial systems. And there's some 1.5 million users and $15 billion of capitalization in that alone. We look at things like non-fungible tokens, which are methodologies of being able to tokenize anything from a concert ticket through to the biggest companies and office towers in the world by digitizing and fractionating and ultimately democratizing them. So when we look at this space, we look at in how to get coverage right across the space. And we do that in a manner which is at an institutional level. So our investors primarily are, family offices, small institutions, and high net worth individuals. And at this stage, therefore, we're not at retail stage.
Right. Thank you very much for giving us background there. And Portal had begun in 2019 and has introduced more than 700 digital fund managers over a short span of time. Can you please tell us more about your result-oriented investment analysis approach, please?
Sure, thank you. So there are a lot of funds out there. Not many of them have very long track records. So, part of the difficulty is filtering those funds to find what we call best-in-class fund managers. To that end, we've built a factor model that looks at their results objectively and quantitatively. So we try to understand how much risk they took to achieve the performance that they achieved. And then we do a full-on operational due diligence, qualitative due diligence. We assess all their service providers and so on. At the end of that process, we tend to have a really good understanding of every aspect of the funds that we look at. We've narrowed it down to around 50 funds that we follow globally. 25 we've done full due diligences on, and we've invested in 9 at the moment. We look to invest across not only differentiated strategies, so we don't replicate any strategies. We also look to invest across volatility and duration, meaning that we invest across the very short-term time frame fund managers that are running market neutral and very low risk strategies, all the way to the fund managers that are running almost like VC type strategies where that's less liquid and the volatility is much higher and the returns tend to be lumpier. I think in a nutshell, that's kind of how the investment process works.
Oh, fantastic. Thank you, Mark. That's the great segue to the next question, actually. And great to hear the diversified strategies that are used in the investment portfolios. So Portal's strategy has returned 46.1% with a target volatility of 15% year to date, current as of July this year, 2021. And Portal has returned 73.4% on average over the last 12 months, which actually exceeds your target of 25% return on investment. Now, this has gained the fund an award from Barclays Hedge, who have ranked Portal Asset Management number 3 in the world out of a possible 6,900 possible alternative investment funds. An incredibly impressive accolade. How does Portal maintain low volatility in a highly volatile space, please?
So it boils down to the correlation between the funds. So we look for funds that tend to perform very well when the market is rising, which is relatively easy. But then we also look for funds that give us downside protection, that perform very well when the market falls. So those funds tend to lose money in flat or rising conditions, and then make really good returns in down market conditions. Long volatility funds is what we call them. It's almost like having a parachute. So what we look to do is blend these fund managers, and we don't mind if they are high volatility, but we blend them in a way that their returns are not correlated. And that sometimes means that we come across a really good fund, but we can't include it in the portfolio because it's just too correlated with the overall market, or it doesn't add risk diversification benefits for the amount of return that's expected. So it's mostly through correlations and investing, as I mentioned earlier, across the different time duration sort of spectrum, across that continuum as well as across the volatility continuum, low, medium, and high risk funds. So, for example, the market was really strong and rallying the first quarter of this year, and we tend to invest counter cyclically. So in around March, April, we started allocating more money and more funds to the very low risk funds in anticipation of potential pullback, which happened sooner and was more deep than we expected. And then at the bottom of that, when everyone is kind of in despair and there's just there's a lot of stress in the market, in July we'd be allocating back to the high volatility funds, because we have a long-term view. We're not really concerned about month-to-month performance. We have we look out 12 to 18 months and try and figure where the market's going to be then in terms of liquidity.
Exactly, and we've seen massive leaps and bounds from earlier this year. As you mentioned, the market was rallying while there was huge institutional investment into the cryptos, and people probably weren't expecting to be able to pay for their Starbucks coffee with cryptocurrency, but now they can. So the space is evolving at a great pace, as Deryck mentioned earlier. And this digital fund sounds like a golden opportunity to gain exposure to the highly dynamic, fast developing yet complex ecosystem of the digital currencies. How does it differ to the blockchain ETFs that have recently emerged as well, please?
So to date, there's no actual blockchain ETFs. There's some proposed Bitcoin and Ethereum ETFs. There's one in Canada, and there's a few other funds that are offering you pure sort of exposure to Bitcoin, let's say naked long only type exposure. I think what we're looking to do is to say, look, we want to reduce the volatility of the space, which is 5 times as volatile as the equity markets. We want to reduce all your operational complexity, because the chain of custody in crypto is very different to the chain of custody in traditional equities. Whoever holds the keys actually controls the crypto. So your biggest risk in the space is actually operational risk. So what we do is we find these best in breed fund managers. We tend to look for managers that have a great pedigree, that have been managing money for at least 10 to 15, 20 years. But then we do a lot of risk mitigation in not only the way the portfolio is constructed, but also in how we manage our operations. We have a Cayman domiciled fund, Singapore-based investment manager. We're fully licensed, fully insured. There's third-party arm's length relationships in how we allocate the capital. So we take a lot of the operational and volatility and the stress out of investing in the space. That's one of the main fund management proposals.
Yes, it definitely should be a keen focus. Cybersecurity and those sort of cyber criminals can cause issues with cryptocurrencies, but we're finding that they are able to prevent the funds being transferred these days, in regards to what Tether did with the recent cryptocurrency hack that we heard of, the largest one in history actually just recently. They were able to stop the money being transferred across from Polygon.
Right. I mean, what was intriguing with that is we actually saw the community come together. There's both technology and community in a manner which traditional institutions can't cope with. So what we saw is $611 million stolen. And within 24 hours, $324 million of it was returned because he couldn't access it. He couldn't do anything with it. there's knowledge of his wallet and who he was, not as a person, but as an entity. So you're able to track who that was. And so what he realized very quickly is that he couldn't spend his $611 million rather. And so accordingly, what had happened is a small part of it was a US dollar tether account, which was held back, as you've just mentioned. Large parts of it were sitting in exchanges that simply locked him up. And the time that the 15-day period from the 10th of August to the 25th of August finished, 611 was stolen and $611 million was returned. So it's an extraordinary thing when you see the actual community and the technology working together to see crimes like that not be able to come to fruition.
No. That's amazing. I think the community that's building up around cryptocurrencies is very exciting to watch, and especially around the non-fungible tokens. But more and more financial advisors are including cryptocurrencies as an investment alternative, as their clients are inquiring into it, with some super funds even using cryptocurrencies as investment instruments. How do you see the introduction of the anticipated Bitcoin ETFs and the emergence of central bank digital currencies to impact the existing investment ecosystem, please?
So I think central bank digital currencies will be, more directly used as actual currency. So for general buying and selling, there won't be a store of value. Bitcoin is more like digital gold. It's got the same sort of drivers as gold in terms of being a store of value and a risk mitigation tool. I think the ETFs could provide retail investors some exposure. Sophisticated investors understand that Bitcoin is a cryptocurrency, but DeFi and smart contracts, NFTs, as you mentioned, are not the same as cryptocurrencies. They're actually more like securities, the way that they trade, and they actually provide access to real underlying business cases, whether it's decentralized exchanges and so forth, insurance products, collateralized debt solutions. So that's where, Bitcoin is Bitcoin, and it'll be there. It's kind of what we call the gateway drug to the space, and you should have a small allocation to it. But I think the real opportunity lies in these sort of almost exponential applications you can build on top of the blockchain. It's like the internet is a thin protocol, and what was built on top of that, the likes of Facebook and Amazon and Google and so on, that's where the money was really made. And in the same space, in the same instance here, blockchain is a thin protocol. It's just a way of accounting as a decentralized ledger for transactions. And what's going to be built on top of that is where there's going to be amazing opportunities in disintermediation. So I think there's definitely a place for holding some cryptocurrency directly yourself. And there's a place for if you want to go out and find funds, if you're interested in spending a lot of time doing the research and you're comfortable with the risk. And then there's a solution, what we offer, which is kind of a set and forget. It's a very simple, plain vanilla approach to the investment side, and we take care of the operational risk, the custody risk, the vetting of the fund managers, and we build a portfolio that gives you upside exposure, but you're never going to keep up with the market because you've got hedges in place. But then it protects you. When the market dropped almost 50% in May this year, we were down 8%. So that's kind of what you're looking for. We give you a much more palatable ride into the crypto space rather than sort of riding a psychotic horse through a burning barn.
Yes, the white-knuckled roller coaster ride, which it's known for usually. So that sounds like a brilliant suspension there. Now we're running out of time, but would you like to add any comments as we close up here about how cryptocurrencies correlate with inflation? And we seem to be heading into a backdrop of high inflation. How do you think it's going to progress in the coming months?
So our base case is that inflation is going to turn very, very quickly once the velocity of money picks up. There's been a lot of printing of money, but the velocity of money, how fast money moves around an economy, has been really flattened as supply chains globally have been disrupted. But that's starting to turn, and we're seeing asset price inflation in real assets, real estate, collectibles, and so on. So I think crypto has benefited from that. It is seen as a hedge and a store of value. And I think that going forward, as fiat currencies start to become debased, which you're seeing a lot with the dollar already, and now 140, it was a lot lower 6 months ago and a lot lower 2 years ago. I think you're going to see, a real shift from potential fiat currencies into the digital asset space. Central bank digital currencies are going to just be, I think, more for transactional for continuing trade globally, and for government to keep tabs on where its spending is going, which is a good thing. But it's not going to compete directly with the digital currency space, which I think will benefit a lot from the coming inflation.
Great. Well, thank you so much for making time for us today and sharing your insights on working in the digital assets and blockchain area. We'll have to wrap it up there. I'm so excited by what the blockchain is doing for renewable energies and energy in general, and hopefully it will add more liquidity to the market. So an exciting space to watch. Thanks so much again for making time for us today, Deryck and Mark. I'm sure your valuable insights have been enjoyed by our viewers.
Thank you for having us.
And if you've just joined us, we've just had a very interesting discussion with Mr. Deryck Graham, CEO and founder, and Mark Witten, Chief Investment Officer of Portal Asset Management. And the full recorded interview will be available from the YouTube channel Calkine Media soon. So please check it out and stay watching for more live expert talks and market reviews. And as we say, invest wise and stay apprised with Calkine.